Generating income on gold sounds fanciful perhaps, but it's not strange at all.
There's a way where you can actually get paid to own gold, and the interest that you earn is paid in gold.
Why not put your gold to work, earning interest the same way that your dollars can do for you as a monetary asset?
We have two programs that people should know about. One is leasing, where you can earn 4 or 5% interest on your gold, and the other is lending via bonds, where you can earn a double-digit return, like 15%. Interest on gold paid in gold. Most people don't think about gold as generating a return, and of course for many decades it hasn't.
It's seen as the safe haven asset. It's seen as the asset to own when currencies are falling, when the banking system is in jeopardy.
People think of it as an inflation hedge, as a way to maintain some store of value. It's seen as an insurance policy of sorts.
Gold also has a tremendous diversification benefit. However, there's a lot more to gold than just those two decisions. There's a lot more that gold can be doing for investors.
Gold can actually be used to finance productive business and generate a return. And that's what monetary metals is all about.
There are drawbacks to owning gold in physical form simply because you have to keep it somewhere. Oftentimes that means at home in your own safe.
If you store it at home, there's no cost per se, but there's an implied cost, which is the risk of loss, because it can't be insured.
It could mean in a bank safe deposit box where you're at risk of having that bank shut down. It could be in a private vault where you're paying to store that gold every month. Or it could even be in the form of paper claims against gold in some kind of ETF or fund. These are all drawbacks that make gold a cost for you to own, when in fact you could be earning interest on gold, earning yield on gold, and having it pay you as a productive asset rather than you paying to hold it.
Monetary metals was created on the idea that we can put gold to work, and so there's not a cost, there's a profit. We pay interest on gold in gold.
Gold was the original monetary asset for the civilized world. We're really reintroducing the original financial reasons for owning gold beyond just diversification, beyond just inflation hedge, and treating gold as a capital asset. But how do we do that? How does that actually work in real time? I mean, how does one make gold productive? Well, it all comes back to what we call the gold yield marketplace.
So this is a place where people who own gold, such as you, can come and bring your gold and find opportunities to deploy it productively and get paid interest on gold in gold. And the businesses who qualify can come and they can find the gold they need in order to operate and grow their businesses.
So in the marketplace, there's a couple of different opportunities whereby we deliver that yield on gold, where we deliver the financing to the gold companies. The first is what we call the true gold lease. The true gold lease is a short term, that means 12 months or less. It's a secured product, meaning it's physical gold at each stage of the transaction. You own physical gold, you're leasing it to a physical gold company that's using it as work in progress or inventory.
These could be refineries, fabricators of all kinds, or maybe jewelry chains. And what we do is we allow them to use gold in a way that their costs are fixed. They don't have to worry about price fluctuations in the spot price of gold. They can just repay us in ounces. In turn, we repay our investors in ounces. Throughout those 12 months, you're earning yield. It's showing up in your account dashboard every month, and the number of physical ounces you've invested with us actually grows in front of your eyes.
If you're thinking about investments on the risk curve, right? Low risk, low return, high risk, high return. The lease is going to be on the lower end of that. So in that product, you're looking at earning anywhere from 2 to 5% in a gold lease. And of course, that interest is paid in gold as well.
The other product we have is gold lending, which we parcel out as a securities offering that we call a gold bond for accredited investors only. And the gold bond is lending to companies that don't have gold inventory, but have gold income.
The bonds are traditional debt finance. We're extending credit to a qualified business that we've conducted the due diligence on. We're not really reinventing that wheel. The one thing that we do different in those transactions is we denominate the debt in ounces. By denominating the debt in ounces, we're matching the core asset of the business to its liability. That lowers their financing costs. It gives them a cleaner, smoother way to immediately tie their production to paying off the debt. to amortizing the debt. And for investors, what it does is it gives them a different yield profile, right? So if leases are here, low risk, low return, our bonds would be one step up. This is debt. We're now exposed to the balance sheet. We're exposed to the credit worthiness of that borrower. But investors are compensated for that risk in the form of a higher yield.
Oftentimes double-digit returns anywhere from 10 to maybe even 15, 18%.
And again, that yield still comes back to them in ounces that are deposited into their account.
In both cases, in the case of the inventory and in the case of the mine, the risk that they would take with conventional financing is what if the price of gold goes down? By borrowing in metal, they match the liability and the asset both go up and down together, and so they remove a risk that otherwise could threaten their business.
You still do own the gold, even when you fund an account with monetary metals. That gold always remains in your name in a monetary metals account. There's no doubt as to who the owner is, it's you, and that's explicitly spelled out in our account agreement.
In the case of a gold lease, you retain the title to it as your property throughout, but you're allowing somebody else to transform it, change its shape and form and location and so on as they operate their business.
So you're actually leasing your gold, it remains in your name, to that final lessee. We aggregate the gold from all our various clients. We lease it to the end party. We manage that and we report on that and deliver the gold interest back to you.
In the case of the gold bond, you are lending, which means you give up possession, you give up title of the gold in exchange for a piece of paper that says this company promises to pay you back this gold with interest.
Loaning or leasing your gold carries some degree of risk, but we work very hard every day to ensure that that risk is minimized through our financial and legal due diligence, through the structure of our contracts, and especially through our robust insurance programs to guard against almost any kind of loss you can imagine.
When your metals are stored at Monetary Metals, they are fully insured. And if you decide to participate in our lease offerings come with additional supplemental insurance. So they're fully insured in the vault, they're fully insured when the metal is on lease, and there are additional policies that we put in place to add an extra layer of security through insurance in that transaction. Whenever we offer a lease in our marketplace, there is a lease presentation. It discloses who the lessee is, how they're using the gold, where the gold's gonna be, and specifically the risks that we've identified in that transaction and the ways we've proactively mitigated that risk.
We look at the company, we want to understand its financial position, its balance sheet, does it have debt, who are the other creditors. We look at their operational controls, we look at physical site security, we look at logical site security, every aspect of how they run their business. Finally, we look at the people behind it. Who are these people? Where did they come from? How long have they been in business? And of course, we present that material to the investors who have a chance to take a look at it before they invest.
The other thing I would say is you have the right to lease your metal, but you're not obligated to lease your metal. You can opt out of any lease with no penalty. It's your metal, you're in control, you decide if you want to lease it or not at a return that's acceptable to you.
There are generally two kinds of investors who are interested in monetary metals programs. The first would be individuals and families who simply own precious metals, especially gold. They're interested in earning a yield on that gold, and they're perhaps interested in not paying so many fees to store it wherever they happen to be storing it. But we also have institutional investors. This could be people brought to us by an RIA. This could be a fund. This could be a family office. And increasingly, we're seeing a greater allocation to precious metals, even amongst these institutional investors. And they want to earn a yield on those precious metals, just like individuals do.
Now, if you're an institution, there's a whole different proposition. What if you take a standard portfolio, 60% equities, 40% bonds, and you put a little bit, 4% gold into that portfolio? What does that get you? And it turns out it gets you slightly better returns. I don't know, it's enough to be excited about, but it gets you lower volatility, smaller drawdowns, better Sharpe ratio. But for gold, there's this cost of carry. And when you plug in, so we use 50 basis points per annum and plugged in and redid the model, then suddenly it sours. And you can see why institutional investors tend not to go for gold. Then we said, okay, what if you plug in 3% interest on your gold? By the way, we're currently paying 4%. But we plugged in 3%, and suddenly, when you rerun the model, it runs away to the upside in terms of total return over decades, and even smaller drawdowns, even better volatility, even better Sharpe ratios. So institutions should be thinking about this at whatever percentage you want to do. You can run the model yourself. It's going to make a material return to all three of those parameters, not just total returns, but volatility, drawdowns, and Sharpe ratio.
With currencies all around the world wobbling, with central banks doing what they're doing, wouldn't you like to earn some money on that gold that you already own?
If you zoom out and you look at the long-term picture, would you rather earn 4% in an asset that perpetually loses value, or 4% in an asset that's perpetually gaining in value? That's the question I would leave to people.